Welcome to AFSPA Talks, a production of the American Foreign Service Protective Association. Each week, we deliver informative health and wellness topics you want to know about, so be sure to subscribe to us on your favorite podcast channel. And if you have any questions about content discussed in this episode, ask them at AFSPA Live, our live Q&A session, streaming every last Thursday of the month at 11 a.m. Eastern Time on youtube.com/AFSPAcares. Now here's your host, Chief Operating Officer Kyle Longton.
Hi, and welcome to another episode of AFSPA Talks. This is Kyle Longton, your host, and I am glad to be bringing you more episodes this month, as promised. And before we dive into today's topic, I just want to remind you that we have a lot of events coming up through the months of October and November, including online and in-person events around open season. So please visit afspa.org/events for the full calendar. And there's also opportunities there to register for some of those upcoming webinars. The full calendar will be populated in the next couple of weeks, so do check back often. And feel free to reach out to us on social media or at afspa.org. You'll find the contact us button there and can send us a message if you have questions. Now, today's topic is a revisiting in some ways of a topic that we explored last year, which is long-term care insurance. So last year we did a conversation with Linda Carruthers of Long-Term Care Consultants based out of Richmond. They are one of our partners for long-term care planning. They offer free consultations to sit down with people to review their current coverage and their needs and help them find the right fit for what their future looks like. And there's information on our website about that. We'll share that in the show notes. And that's a great overview of what long-term care insurance is and some of the new offerings that are out there. Today, we're going to talk about the federal long-term care insurance program. And before I get to that, I just want to mention the importance of long-term care insurance. And many of us have experienced this in our own lives, but it has been very personal for me. 3 of my 4 grandparents found themselves in a multi-year situation, I should say multi-year situations, where they required long-term care, some of it initially at home, and then eventually in facilities, moving in some cases from independent living to assisted living to nursing care. And there are a lot of options for this out there, including continuing care retirement communities and other settings where people can buy in and receive this care. But I think for me, I saw one grandparent in this condition for upwards of 4 years, another for 2 years, and the last for 3 years. And it was a challenge. Prior to going into facilities, family members were spending a lot of time going to visit them, going to make sure that they ate that day, making sure that they had taken their medications, doing small household chores. And this was after those family members had already spent a day working full time. And in some cases, working full time, caring for kids or teenagers, and then also caring for a parent. And this is the reality for so many of us. And part of that is because of the cost of long-term care. It's also about wanting our loved ones to stay at home for as long as possible. It's about feeling, oh, they're not at a point yet where they need professional care I can do for them, and so forth. And all of those are true. They are all personal considerations each of us has to take based on the situation before us. But I just want to encourage everybody who's listening and to really think about long-term care needs for yourself as well as for your loved ones, to make sure that everyone has the care and the support that they need, including those caregivers. Make sure they've got some sort of respite care, some sort of relief when they need it, just to go shopping, just to go out and get a haircut. You can just take a walk around a park and so forth. There's a lot of different use cases for long-term care. It's not just for elder care. It can be used in a lot of situations. So I encourage you to go back and listen to that episode from last year, hear about some of those options that are out there, and think about what your situation, your family situation is. And the other thing I want to mention, and our guest today and I talked about this a little bit after our recording, is that long-term care insurance is something that once you lose it, once you stop paying for it, you can't just re-enroll. So that is the reason people go to such lengths to make sure they keep paying their premiums and keep paying them on time. Because a lapse, it can be very difficult once you've lost that plan to either get back into it or to get a new plan, depending on your age and medical situation. So please keep those things in mind as you listen to today's podcast. And today, as I mentioned before, we're focused on the long-term care insurance program, also known as LTCFEDS. And the program right now is going through a contract renewal, which happens every 7 years, which also means it's only every 7 years that they can raise premiums in this program. And that's what a lot of people are experiencing right now. We're going to talk more about that with an expert, so I'm not going to go further into that. I'm going to right now just introduce you to our expert, and it is someone who's been on this program before, who is a living legend in the federal benefits space, and that is Tammy Flanagan. She's been providing retirement planning assistance to federal employees since 1985. She first began her work as a retirement benefits specialist at the Federal Bureau of Investigation. Her extensive knowledge of the federal benefits system and her ability to explain difficult concepts in an easy to understand manner has made her a sought after speaker and presenter. We're very lucky to have her at pre-retirement seminars, training conferences, and online training events. Throughout her career, she's also enjoyed assisting individual employees by providing guidance and pre-retirement benefits counseling. You can contact Tammy's team and find individual retirement and pre-retirement counseling services at retirefederal.com, and we will link that in our show notes. I also want to note that Ms. Flanagan is the Senior Benefits Director for the National Institute of Transition Planning, which has been conducting pre-retirement seminars and workshops throughout the Washington, D.C. area and beyond since 1987. Since 2006, Tammy has offered the popular weekly retirement planning column for Government Executive Online Magazine. More than 250,000 subscribers have learned how to prepare for a smooth transition to retirement through this regular feature. Tammy has been a member of the National Active and Retired Federal Employees Association, or NARFE, since 1988. In 2015, she engaged with NARFE to provide training through NARFE Federal Benefits Institute that was implemented in that same year. NARFE provides many valuable services to federal employees and retirees through membership. Ms. Flanagan is a frequent co-host of the 4-year benefit radio program that is heard on Federal News Network. The hour-long broadcasts are archived online and heard on Mondays at 10 a.m. Eastern. And later this month, our own CEO, Paula Jacob, will also join Tammy on 4-year benefit on the Federal News Network. I also just want to highlight a couple other things about Tammy before we get to the interview. She was honored to have been selected as one of Money Magazine's Money Heroes of 2012 for the service that she provides to help federal employees prepare for life after retirement. In 2015, Ms. Flanagan became certified in long-term care insurance and has conducted webinars and live events for the federal long-term care insurance program. Now, in addition to this podcast, she also has webinars that can be found archived at LTCFEDS.com. Finally, through her relationship with Micah Shalansky, who's a certified financial planner, Tammy's newest endeavor, is a popular podcast that she co-hosts with Micah called Plan Your Federal Retirement. That might be very useful to many of you listeners. So without any further ado, let's get to the interview with Tammy. And Tammy, welcome back to AFSPA Talks.
Thanks, Kyle. It's great to be here, and thanks for asking me back.
Well, we're so glad to have you and your particular expertise right now, as it's incredibly valuable to our listeners and to so many others. You joined us once before, almost about this time last year, to help us talk about your work with Retire Federal and also to decode the Federal Employee Group Life Insurance Program, or FEGLI. I think you're one of 3 living people who truly understands the program. And so I'll encourage our listeners to go back to that incredibly informative episode. But today, you're going to help us with another program that touches a lot of lives, but not a lot of people necessarily understand, and that's the Federal Long-Term Care Insurance Program, or LTCFEDS. Can we start with just a little bit of history of LTCFEDS? It's one of the younger federal insurance programs. When did it launch?
Yeah, I think it was back in 2001, I believe, because we've gone through, this will be our 3rd round of contract renewal, and that happens every 7 years. So it's been about 21 years that they've been around. So it's give or take a year.
Okay. And so just generally then to maybe even take a step back further, for those who may not be familiar with long-term care insurance generally and even the federal program in particular, what are we talking about? What does LTC Feds cover?
Well, one of the big things that can cause a financial catastrophe, we have insurance to insure against financial catastrophes, whether it's homeowners, car insurance. So long-term care, as we're learning from our parents, from our neighbors, from our relatives, long-term care can be very, very expensive. If you do it at home, which a lot of people, in fact, the majority of long-term care takes place at home, but the providers are family.
Yeah.
And it takes a toll financially because sometimes you have to retire early to become a caregiver. I hear that at my seminars all the time. Or it takes a toll physically because like my mother, she was physically dressing and bathing and feeding my father whenever he was in the later stages of dementia.
Mm-hmm.
It takes a toll definitely emotionally. Your spouse, who was once your loving partner, is now you're being their caregiver. You're treating them in a totally different way, and they may not even remember your name. So just to start off with, long-term care itself is a big problem. It's a big issue in this country. It's something that a lot of us will face. The older we get, the more likely it is that we may need a period of long-term care. So we're trying to find ways to plan for it. We plan for everything else. We plan for retirement. We plan for buying a house. Now we got to plan for the eventual possibility of long-term care. So back in the time when this was new, there were 100+ companies selling long-term care insurance. Today, I believe it's like on one hand, the number of companies that are out there.
Yeah.
Majority of it sold through things like FLTCIS, which is the employer sponsored type of insurance rather than going out yourself and buying. Although you can go out and buy policies, which is good to know because our federal long-term care plan is now suspended for new applicants. So you're going to have to go out and buy it yourself if you don't have it, at least until OPM lifts that suspension, which might happen next year. But this insurance, I don't look at it as the answer to the problem of long-term care because most of us would not buy enough coverage to cover the full cost of 10 years of dementia. That would be cost prohibitive. But I look at it more as a gift to your family because their number one in line is caregivers. So if nothing else, this can provide some respite care so that someone can come into the home, give you a break, let you go out and go shopping, let you go out and play bridge or whatever it is you want to do to get a little bit of relief from that 24/7 job that you might be enduring. When it comes time to someone who's single, who's on their own trying to find a caregiver, it provides them the ability to stay in their home rather than move to a nursing home right away or assisted living. Now, if it does come to the point where you have to go to a facility, well, this is going to help you get in because, of course, the facilities don't want you coming in on Medicaid because that program doesn't pay the same as you would pay out of pocket your regular fees. So this will give you a kind of a leg up on getting into a nicer facility as well. So I do think it plays an important role for people, especially people who want to protect their assets from being spent too quickly. For people who are married, it helps protect your spouse's assets from being spent. And if you're single, it provides a way for you to provide care for yourself without relying on family who might not be close at hand. They might not be nearby. So I think it does play an important role. But we have seen, and this is not just the federal plan, but we have seen rising prices throughout the industry. And the federal plan has been no exception. And a lot of people are upset, including probably OPM, which is why they suspended it to try to get a hold on these rising prices, try to figure out a way to stabilize what's happening.
Right. And so I want to dive into that. So OPM and in partnership, the plan's actually administered by a John Hancock subsidiary. And they suspended new enrollments and changes to enrollment this past December. And as you mentioned, that's pretty much closed down until they're saying December of 2024. Maybe after that, maybe a little bit before, but that's the date they put out there. So, and you've also mentioned that there are these 7-year contract cycles. So what's happening right now? Why are we talking about it today, I guess, is the better question.
Well, the new contract came about. The good news is that John Hancock got the contract renewed for another 7 years. And to tell you the truth, I don't know that many, if any, other companies out there even bid on the contract.
Mhm.
You know, this plan covers over 250,000 enrollees. So it's a large plan. It has to be of a certain net worth and certain rating to even get the contract, because we have to protect our people who are enrolled to make sure this is going to last, make sure the company doesn't go belly up. And John Hancock is definitely fit to serve that role. But what's happening right now is we're being offered the option to either accept a premium increase starting on January 1st, or another option, which would allow us to maintain the same premium, but smaller benefits. So it's not a great option. Either you get less for the same money, or you get more, or you get the same for more money that you already have, you know, and it's going to keep going up. So I'm in the same boat. My husband and I both have the FLTCIS program. So I've got my letter here. It's telling me I have until November 9th. So I'm in the same boat as everybody else who's holding these policies. We're not happy. Obviously, it's not a nice thing to say, hey, your premiums are going to go up. And I'm looking at a premium that's going to go up from $148 a month to, when it's finally leveled out, $221.
Wow.
Yeah, so we're not talking $5 a month or 7% increase. It's a huge increase, and everybody's going to be a little different. It depends on when you signed up. It depends on how old you are now. It depends on which version of inflation protection you elected. So there's a lot of moving parts. So you can't compare what happened in your situation or my situation to what's happening to somebody else, because someone else might say, oh, mine's only going up, 40%. Somebody else's could be going up 70% based on their set of circumstances.
Well,
But the important thing is to understand your choices.
well, and so I want to stop for a second, because you talked about sort of different options within the federal program and inflation protection and so forth. And I've even seen some communications about 1.0 and 2.0 and 3.0 and so forth. And I'm wondering if you can talk a little bit about the differences between those versions, and how how this rate increase at the 7-year contract mark, it may be affecting those versions differently.
Right. Well, version 3, let me start with the newest one first. Version 3.0 was implemented in, I think it was October of 2019. So it's only been around about 4 years. It does include within it a premium stabilization feature. So those premiums are not changing right now. They're what they were whenever you signed up in 2019. So if you're someone who bought a policy then, you shouldn't have received the letter. You're wondering, why didn't I get a letter? Well, it's because you just bought in, and those rates are not going up. Good news there. Now, if you were in version 1.0, as I am, or version 2.0, as my husband is, because he signed up later than I did, those are the ones who are getting the rate increase letters. There are some differences between the two plans. They change the daily benefit amounts. They change, like in my case with the older plan, I can have a weekly benefit, which is kind of flexible. So I can use it in 3 days or over 7 days, where my husband's plan is a daily benefit amount. It's per day. So if he goes above that amount per day, it stops paying. So there are some of those kind of subtle differences between the different plans, but they all provide for in-home care. They all provide for an informal caregiver, which is a family member who doesn't live in your home, a neighbor. So you can pay somebody who's more familiar to you that can provide the care for you. They'll even pay for caregiver training or home modifications. So you have 30 times your daily benefit to cover training for a caregiver, or widening your doorway so you can get the wheelchair into the bathroom, or whatever needs to be done. So those are some really nice features. In fact, I was looking at some of the statistics, and so far since 2001, I think it is, $2.4 billion in claims have been paid. So this plan is paying. In fact, I have a neighbor right here in Florida who's receiving benefits through FLTCIS. So she was very grateful to have those benefits so she could stay home. Her husband's providing her care, but she has someone coming in. Unfortunately, she has ALS. She's not even in her 80s or 90s. She's much younger. The approval rate for getting benefits is 96%. So typically when you get to the point where you need that caregiver, they're going to agree with you. They're going to send someone out to make sure you need assistance or you need supervision. So it's not that uncommon that you get approved. Yeah, that's the norm. 90,000 average claim per claimant. So that's a lot of money coming back to you for what you've paid in premiums. So far, I've paid about 20,000 in premiums. So if I got even 90,000 back, that's a pretty good rate of return, even if I needed it today.
And I think that points to maybe why there are some financial challenges within the program also, if we're seeing that average rate.
Mm-hmm.
In just 20 years, it's unlikely most enrollees will have paid anything close to a return of $90,000.
Yeah,
So
I'm sure your insurance brain is
yeah,
really
absolutely. And it's also occurred to me why we don't have a group policy that we can offer through AFSPA anymore. We did for many years, but they're just not. They've proven themselves not to be sustainable from back in the 90s when we offered them.
That's right.
And I just want to confirm that 2.4 billion, that's just the federal program,
It's
right?
just the federal plan. That's all
Wow.
FLTCIS.
Okay. All right.
So
All right. So, and you mentioned before, people with 1.0 and 2.0 versions are getting these letters. They've got an option, basically keep the same benefits, pay more in premium, or continue paying about the same amount in premium and see a decrease in their benefits.
well, yeah. So in our case, in everybody's case, you get at least 3 choices. Some people are getting 4 different options if they have the future purchase option as the inflation protection.
Okay.
There's one option I want to explain though, because it's to me it was confusing until I looked deeper into it. And it's the option where you can do a maximum lifetime benefit. And what that means is you've already paid in, like in my case, here's what I paid, $24,447 is my total premiums. I signed up when I was 47, so I've had this for 18 years already. So I paid in almost $25,000. My benefit is currently worth $421,000 worth of benefits if I were to go into claim today. But if I chose that option, I wouldn't pay any more premiums. It would be free for the rest of my life. However, the only thing it's going to pay out is $24,447. So it's not going to pay out the $400,000.
Okay.
So you can just basically leave your money in there. It's not going to grow for you, but you can just spend that money till it's gone if you ever need to go into claim. So the only way you get the money back is to go into claim. You can't ask for a refund, but at least you won't lose the value if you should ever need care. To me, that's a really bad option because you basically let your money sit under your pillow for the rest of your life, and you may never even get it back. So I'm choosing between a lower inflation protection. So it's going from 3.9 down to 2.75, which means my benefits aren't going to escalate as quickly, but at least they'll go up a little bit. Now, I did make a call to them because I wanted to know, I have 5 years of coverage. So that means I'll get to use that benefit for up to 5 years before it runs out. It could even last longer than 5 years if I don't spend as much per day. So it can go a little bit longer. But I called up to see, would they offer me 4 years and keep the same inflation? I was trying to make a deal, right? You want to kind of negotiate this. So I called up and they were willing to make a deal. However, the deal was 3 years, not 4.
Okay.
So I'm looking at that. I'm thinking, well, the average length of time benefits are received, 32 months. So 3 years would cover well over 32 months.
Right.
But on the other hand, I know we have dementia in our family, and that's not a 32-month disease.
No. And as you mentioned, a lot of people do receive at least initial care at home from family members, but that respite care can be so important because it can wear out spouses and children and others. But it's important to have some sort of coverage and to use it when you need it. I think is the other thing. That what are you keeping it for? Maybe down the line when more intensive care is needed, but in the meantime, there can be some benefit to everybody for utilizing those benefits.
For sure.
And Tammy, I appreciate you sharing that you called because I think a lot of people are thinking, oh, I don't know, Tammy knows all of this. She's certified in long-term care insurance and even she's calling. So that's great. So I want to share with our listeners, if you receive one of these letters, likely the contact information's on there. You can also go into the LTCFEDS.com. You can go into the portal there to access your information. And then if you do have questions, it sounds like they're absolutely open to questions. They're open to talking about different options. So give them a call at 1-800-LTC-FEDS or 1-800-582-3337. And we'll put all that information in the show notes for today's episode as well. And I just want to reemphasize something that Tammy mentioned before. You have until November 9th to make your decision. And Tammy, if I remember correctly, if you don't do anything by November 9th, you will see the premiums increase, keeping your same
Yes.
benefits but higher premiums.
You do have to be proactive, right? To
Okay.
avoid that increase, it's going to come to you on January 1st. And the way it's going to work for most policies, you're going to have that increase once a year for the next 3 years. So the first one won't seem so bad, but then the second and third one is going to keep going up. So please either call them or make your decision by November 9th, because you do have a choice in this. You don't have to pay more money. Although it does mean you'll get a little less benefits in the end, that might be the best compromise between the two.
And I want to ask, other than this podcast, which is incredibly helpful, are there things that you and your team at Retire Federal can help people if they have questions about these changes? I imagine you were looking at about a month by the time this podcast comes out before the decision date. So in that month, or for others who are looking down the line, if you can talk a little bit about what you and your team can do for folks.
Sure. We have on our website, you can ask us questions, get more info, or just go to the little chat box there and you can ask us whatever you want. And in most cases, if it's a question, just a simple question about this, we're more than happy to answer those. If you need help with pre-retirement planning or some major decisions, we do have a service that provides one-on-one counseling, and our website is retirefederal.com.
All right, and we'll be sure to link that and a few other resources you shared with us from some of your other work, including your podcast, in our show notes. So I'll encourage everybody to take a look at those. And Tammy, before we wrap up, is there anything else that you feel our listeners should know? Anything you think we've missed?
There's just one other thing, and I didn't know that this was a thing, but I got a call from someone, not during this go round of what's happening here, but it was from a woman who lives here in Florida, and she has a long-term care policy, and she's actually in claim. She has a caregiver coming into her home. Well, she's been receiving benefits now for close to 3 years, and her benefits starting to run out. So she called Long-Term Care Partners to renew her policy. And she didn't understand the fact that 3 years is 3 years. Once you're in claim, it's not going to go up anymore. So you have to make a plan. Like I said in the beginning, this isn't the answer to long-term care. Because if you have a 3-year policy and your care is needed for 5 years, then you have to make a plan for what happens when that policy runs out. Are you going to start spending assets? Are you going to make plans to move to assisted living? What is the next step? Because there's going to be a next step if you make it beyond that benefit period.
Absolutely. And I think one of the other things you mentioned, just sort of the age at which you enrolled, is important for people to keep in mind as well, that looking at this coverage, particularly when you're in your 40s, is a particularly good time to think about it. Most of us are still in relatively good health, maybe haven't developed some of those things that come along. And it's easier to look at your options, and you have more options to enroll.
Absolutely. Because Kyle, if I tried to buy my same policy at my age today, I couldn't afford it. It would be twice as much as what I'm paying, even with the increase. So even if I accept that increase, I couldn't touch it. So the age you are when you buy into it helps you stabilize some of those increases, even though you may see this I don't believe is going to be the last time we get one of these letters.
Yeah.
Well, I will say though, one last thing. With interest rates going up, that's good news for the insurance industry, as you probably know, because interest rates have to be not real risky products. They have to be things that are more stable. And we know those interest rates have been low for many years now. But now that those rates are rising, that should help stabilize these premiums. So let's hope that in the next 7 years, we don't see this type of an increase again.
Right, and we will have you back in 2030 to talk about it at that time.
I'll have my walker.
That's okay. You'll still have the knowledge and be going. So we'll figure it out. But Tammy, thank you so much for joining us and for sharing your expertise with us today. I'll encourage our listeners to take a look in the show notes to find out more about Tammy and her colleagues at Retire Federal and how you can connect with them. So Tammy, thank you.
Thanks so much, Kyle.
Thanks again to Tammy Flanagan from Retire Federal for joining us for today's episode. You can visit afspa.org/AIP/professional services for more information about Tammy and her colleagues at Retire Federal as well as for information about long-term planning partners, such as long-term care consultants that AFSPA has in our portfolio of partners. This has been AFSPA Talks, a production of the American Foreign Service Protective Association. All information offered in this podcast is meant to be educational. The views expressed by the hosts and guests are their own and do not necessarily represent AFSPA. Should there be any discrepancy between information offered in this podcast and official plan documents for the Foreign Service Benefit Plan or the other products offered by AFSPA, the policy provisions will prevail. Thanks for listening, and be sure to subscribe to AFSPA Talks to catch our next episode. Please rate and review us on your favorite podcast app, and share feedback with us on Facebook, Instagram, or LinkedIn. Search for AFSPA Cares. We'll talk again soon.
Thanks for joining us this week on AFSPA Talks. Be sure to subscribe to our channel so you'll never miss an episode. If you have any follow-up questions about the topics in this episode, join our AFSPA Live Q&A session on the last Thursday of every month. We will be streaming live on our YouTube channel at youtube.com/AFSPACares at 11 a.m. Eastern Time to answer your questions. Thanks for listening.